I'm here today with Bruce Stout, who's the manager of the Murray International Trust. Now, this is a trust that I know a lot of readers hold, so I think we have an awful lot to talk about. Now, the first thing I want to ask about is, because turns out the last interview I did with Bruce, I know a lot of you will have read, and that's about deflation. We talked a lot last time about the deflationary environment, and I just wonder, Bruce, is that playing out the way you expected?
Well, we're not at outright deflation yet. Outright deflation is when consumers start deferring purchases because they think they'll get goods and services cheaper in 2 weeks or a month's time. But we're certainly at a period where prices are falling in lots of different areas. We know in commodities, in oil and iron ore and copper and the primary metals, but also in retail and services. A lot of pressure on pricing because a lot of customers have got debt, both the private sector and the public sector, and there's still far too much capacity chasing too little demand in the world today. The issue about deflation is not, whether it happens or not, it's what does it do to corporate profitability when you're forcing prices downwards, and that's the biggest issue that we have.
Is it partially, we talked about debt, but is it partially a demographic issue as well? Ageing societies have less demand.
It's certainly gone on in the developed world for a long time because we do have an ageing demographic, there's no doubt about that. It's not so much about the age structure though, it's more about real incomes and the fact that the jobs that have been created in the last 5 or 6 years are not high paid jobs, not in the developed world. We've seen a lot of 0-hour contracts, we've seen a lot of lower paid jobs, and these jobs are, we know they're low paid because they're not contributing to tax revenues, they're that low, so they don't really sustain consumption, and for consumption based economies that's a real problem.
But we are beginning to see some pressure on wages, aren't we? We're seeing real wages beginning to tick up slightly, we're seeing demands for higher minimum wages, etc. There's some pressure here on wages.
Well, there might be demand for higher minimum wages, but whether they get them or not remains to be seen. I mean, the main issue is if there's areas of scarcity in certain skills sets, then you will get some wage pressures, there's no doubt about that. But just in general, real wages continue to fall in most of the developed world. That's what the numbers tell us, and that's what the purchasing patterns tell us as well, that people continue to cut back on volumes that they buy, they continue to trade down from branded goods into more generic goods and also just buy less.
So I'm guessing that you're not really a believer in the Great British Recovery.
Well, I haven't seen any evidence of any sustainable recovery that would match the type of stimulus that's been applied, because in the last 6 years they've really thrown the kitchen sink at the global economy, and for many governments they've increased the size of the balance sheets by a factor of 3 or 4 times through printing money, and the best they can generate is 2 or 2.5% growth. That's very, very low relative to previous cycles. So remains to be seen, once quantitative easing stops in the States and no doubt somewhere else, maybe in the UK, will they be able to stand on their own 2 feet? Well, we'll have to wait and see.
I'm guessing you think you know the answer though.
Well, it's very difficult to predict, and growth itself doesn't translate into profits. The most important thing for us as investors is, can the companies that we invest in make money? Can they make sufficient free cash flow to reinvest in the business and grow the business, and also return cash as dividends to us as shareholders? That's the most important thing, and therefore any read on the backdrop of the environment is with an aim towards trying to make that assessment, whether they can grow the profitability.
Would you say that markets across the developed world, not just in the US, but across the developed world, are overvalued at the moment? I mean, I think there's a general consensus among most people that the US is remarkably expensive, but elsewhere that consensus doesn't exist.
I think on any sort of historical measure, markets are very, very expensive, and we know that quantitative easing and the liquidity has pushed prices up, and we also know that central banks have neglected their main job, if you like, which is looking after growth and inflation in economies, to focus on controlling asset prices, and that's not healthy. We also know with no returns from cash or negative yields on bonds that people feel compelled to buy equities, but you have to be very careful, because if you pay the wrong price you'll lose your money.
So what will prompt these equity markets to fall back?
I have no idea. I mean, ultimately the only thing that holds an equity price up is earnings and dividends, not hope and expectation, not hot air, and not liquidity. So if a company starts to see its earnings go down, then at some point in time, either the multiple compresses or the capital value goes down. So profits and dividends are absolutely key in this type of low growth, low interest rate environment. And where you're unsure of them being delivered, then you have to be very wary.
So where can we conceivably be sure of them being delivered?
Well, obviously the market makes judgments about that and looks at sort of traditional areas of profit dependency in things like consumer staples and things like pharmaceuticals. But these multiples on those stocks are already very, very high, and some of them are high double digit or even in the 20s, yet the realistic earnings growth is in the low single digits. So just because an industry is perceived to be safe doesn't necessarily mean it is if it's still very expensive to own.
So if you pay too much for it, it's still dangerous.
Absolutely. So we have to sort of look around areas where perhaps expectations are lower, where there might be a bit more cyclicality, but where there is the definite tailwind of rising real incomes, of rising volumes, rising purchasing power, and that's into the emerging markets in Asia and Latin America and parts of Africa, where although they're coming off a low base, they don't have the debt overhang, and they do still have rising real incomes and demand for goods and services. So these sort of areas are completely out of favour at the moment, and in fact there's almost widespread revulsion towards anything commodities, anything oil, anything emerging markets or emerging debt, which is very interesting because we've not really seen such conviction from the consensus that there's only one trade in town, and that's the strong dollar and the strong US, really since the 98-99 period when the US dominated returns, and then we all knew what happened after that when the technology bubble burst. So if you're looking for, to be a bit contrarian and not just follow the herd, then you have to look elsewhere that's out of favour, but where good profits and dividends are realistic.
Okay, you mentioned investing a little in Africa. What areas are interesting there?
It's very difficult to get direct investment into Africa for a big trust because the markets are very small.
Yeah.
So you have to look at perhaps companies in the developed world that are selling into Africa, or individual positions. I mean, MTN is the South African mobile communications company with businesses in Nigeria and South Africa and the Middle East. That's quite interesting, and there's one or two others that have certainly got good growth ahead of them.
And elsewhere in Asia, you mentioned you invest a lot there.
Asia is always very difficult as well because it's dominated by China and the outlook for China. And the other thing that's quite interesting about it is if you look at the development that Asia's made in the last 10 years in terms of contribution to global GDP, which is huge, the growth, but the market cap hasn't really grown in line with that because there's still a great reluctance for families to go public with their companies. There's no need. Why would you float your company into the public market to have the scrutiny of analysts every quarter when you don't need to, because you have access to capital, and there are now developed bond markets in emerging markets in local currency out to 30, 40 years, so you can borrow in local currency and match your liabilities. So there isn't the desire to go public, and there isn't the stock of equity, and some of the best situations are still in private companies, so you need a specific vehicle to take advantage of that.
Okay. And China, and my guess is that you're relatively pessimistic on the economic situation in China.
Not really. I think you have to be sort of totally pragmatic towards China. It's a $11 trillion economy. It can't grow at 7%. I mean, the US was an $11 trillion economy in 1999. If it had grown at 7%, what would interest rates have been? At that rate of growth, you're going to get bottlenecks, you're going to get wage inflation and things. So at some point in time, it has to slow down to a more manageable 3 to 4% growth rate.
Well, a lot of people say it already has, but 7% is the fantasy anyway, and it's already 2 to 3%.
You don't know what the actual growth rate is, you just know it's slowing down from what it was before. But ultimately, if they want sustainable non-inflationary growth, it has to be in the sort of 3 to 4% range. But whatever they need to do, they will do it.
So there's no great China crash coming?
Well, I mean, they're very aware of the shadow banking system and the issues that they have in terms of falling property prices and the misallocation of capital through some of the fiscal policies they've had. I suppose the thing we have to watch is that if they do start to devalue the currency significantly, then that will be another wave of deflation that will be exported around the world. So we need to keep an eye on that. We work it out based on where the company earns its money, and therefore when you look at the direct holdings in emerging markets in Asia, and then you look at companies such as Casino in France or BATs and businesses like that that have large overseas exposure, then that's still the main theme within the trust. And on the longer term basis, that's still where we see better relative growth, the tailwind of falling interest rates at some point in time, and surprises on the upsides in earnings. If the danger for developed market companies is not delivering earnings in a difficult environment, then the opposite hopefully will be the case in the emerging world in 2 or 3 years' times, where expectations are now so low that there's a chance that growth will exceed expectations.
What would make you feel more positive about the developed world? Is there anything that would make you go, well, actually, no, the UK isn't so bad, there's good reason to invest here?
There isn't any reason to become positive, just as there isn't any reason per se to be negative. I mean, what we try to do is just be realistic about what's in front of us, and using that information, can we make sensible judgments about the future? The main issue we have just now is, for you and for me and for everybody involved, is that many of the relationships that persist, we've never seen them before. We've never seen negative nominal bond yields on 3 trillion euros worth of bonds in Europe. We've never seen being charged to put your money in a bank in Switzerland or Germany or Sweden and Norway. And we've never seen deflation, we've never seen prices fall, and the pressure that puts on raising revenues. So when you try to use your experience to predict the future, you look for evidence of things that you've seen in the past. And if you're facing a situation where many of those relationships you've never seen them before, then you have to be very cautious. You don't necessarily have to be negative or positive, but you have to try and work out what you're dealing with. And to a large extent, in some areas, it's the unknown.
So with that in mind, how does a reader allocate their portfolio? Obviously they hold little Merryn International, maybe a lot of Merryn International, but what else do they hold to hedge themselves against this environment?
Well, this is the whole centre part of the difficulty that we're experiencing at the moment, is that with no return on cash and bond yields negative, then a whole generation that's used to holding bonds is now watching their savings being eaten away by inflation. So what do they do with their cash? Well, they're going to have to ask an investment advisor, because they can't ask people like ourselves.
Should they not hold cash?
If you have a certain process and a certain style, you can't do that in all market situations. So, of course, when markets go down, people want to preserve their capital, but in the last 12 years we've had 2 down markets, that's all. So for a lot of people, the memories are distant of 2000 and 2001 and 2002, when we had 3 straight down years. So they get caught up with making more money perhaps rather than preserving capital. But if we do get a shakeout, then I'm sure that will become the #1 priority item.
I think it might be already. Bruce, if you ruled the world, which you could,
there's certainly no chance of that ever happening. No.
How would you sort out this weird, over-indebted, deflationary environment in the UK, the US?
Well, we wouldn't know where to start, would we? Because it's so completely alien to the financial structures that we've been taught at university or read about in the newspapers or learned from our parents or whatever. This environment in which we live is totally alien.
So you can't see a way out?
Well, it's very, very difficult, because it depends what kind of pain we're prepared to take.
Let's say we were prepared to take pain. Let's pretend that we live in a world where everyone's rational and is prepared to take short to medium term pain for a better world.
The real issues are always the same. It's always the young people and the elderly people who suffer the most and take the most pain. So the result of the debt crisis, the result of quantitative easing and the huge debt loads that have been placed on means that the debt that young people now have limits their opportunities significantly. So the average age of a first-time buyer has risen in the UK from 6 years ago to 33, 34. So I hope you like your children, because they're going to be living with you for a very long time. And by the time you put on student debt on top of that, and then looking for 10 or 15% down on your first house, it basically makes the housing market, completely inaccessible to younger people. And then on the other end of the scale, the elderly with their pensions are watching their savings being eaten away by financial repression and the suppression of bond yields to levels that won't meet the liabilities. So it's these two groups that always suffer the most.
But we do know that in the UK, pensioner incomes have been fine. If you look at the statistics, pensioners have not been the ones who've done the worst, it's been the young. But then when I write about that, the pensioners write in to tell me, quite rightly, that the young are far too profligate, and if they spent less money on cocktails and coffee, things wouldn't be so bad. So I sort of feel a little conflict starting here.
Well, I suppose if they spent less on cocktails and coffee, then the consumer side of the economy really is going to go downhill. And given that all developed market economies are consumer-based economies, then that's what central banks have been trying to get people to do for the last 6 years, is spend some money. But of course, that's the great difficulty when the credit cycle doesn't work and you push on a string because there's no price for money. You can lower rates to zero, but you can't make people borrow.
Make people spend.
You can take the horse to water, but you really can't make it drink. So it's a very difficult situation, and it's the cost side, I suppose, for people like pensioners. Do we really see energy bills falling through the floor as energy costs have fallen, by 50% since last year? Well, my gas bill's certainly not down 50%, neither is my electricity bill. And it's not because we're using more. So I suspect that, as always, these prices are rigid on the way down and very quick to go up. So that's what eats into pension and disposable incomes.
Yeah. How about we try and end on a positive note? Positive note. What's your favourite stock in your portfolio?
You don't have favourites. Do you have a favourite child?
Of course not.
No, well, you can't have a favourite stock.
But on the other hand, I don't have more of one child than I do of the other child, and you in your portfolio will have more of some stocks than you will of other stocks. So you've already expressed a favouritism.
Not if you're being simplistic to say that by holding twice the amount of one, you prefer it twice as much as the other.
I am simplistic, but you know that.
That's the sort of logic that doesn't take valuation into consideration, because obviously you want to have twice of something that's half the price of something.
Okay, let me rephrase. What's your favourite stock taking valuation into consideration?
We don't have favourites. You don't have favourites. We have 46 stocks in Merryn International, and like any group, every single company we own has problems. They have issues. They're trying to do business in this difficult world that we've outlined. They're trying to grow their revenues. They're trying to compete with people who are cutting prices to provide similar services. We often forget in investment management that the hardest job is running a business. If you're actually running a business and you have a headwind like that, then that's very, very tough. And it puts pressure on expansion and investment, because you have to be very bold to spend money and invest for the future when the near-term outlook's very opaque. So I've got a lot of respect for all the businesses that we own and the people that run them, because I know it's such a difficult environment, and some are going to be have more success than others in the environment in which they find themselves. But to be able to do it and actually come in and try and run a business for shareholders and for the staff at a time like this is very, very difficult. So they have to be supported.
And you won't tell me what your favourite stock is.
I don't have a favourite stock.
Okay, what's the most recent stock you've added to the portfolio?
There was only one new stock that was added last year, and that was Sokimich, which is a potash producer. Also produces lithium for batteries and iodine, and it's based in Chile. And it's had a particularly difficult time in markets. One, because it's located in an emerging market, and two, because the potash market's not been easy in the last few years. So there's a lot of bad news discounted in that company's share price, and that's why we initiated that position last year, and I'll look to build it up on weakness.
Brilliant. Thank you very much.
Okay. You're welcome.
We've seen price falls in the housing market in the past, in the early 90s, and they went down 50%. And I think that we're at the start of that kind of decline now, as I think indeed fairly soon we will be at the start of that in the stock market as well.